In this quick video, we're going to discuss funding your house flip projects and how you can set up your funding in our Flip Analyzer tool. You have two options for funding your projects. You can use your own cash or you can use a loan. If you're a cash investor and are fortunate enough to have enough investable cash to fund your own flip projects, you can just select the cash option and just move on to the next step. Now, if you aren't going to be using your own cash and you're going to be using other people's money to fund your projects, you'll want to select the loan option. The most common way to use other people's money is to get a loan from a hard money lender or a private money lender, where the lender gives you an interest-only loan and in return you pay the lender monthly interest for funding your project. So that's the way we have our loans set up here. The loans are interest-only loans where you're only paying interest on the loan and you're not paying any kind of principal like you would on an amortized loan. So let's dive into the loan setup. You can set up to 3 different loans to fund your deal. So if you're going to be working with multiple lenders or partners to fund your deal, you can set up different terms for each of those loans. So the first value to set up is the loan amount. You'll see we have a few different loan options that you can choose from. We've got a lump sum option, the purchase option, repairs option, and then the purchase and repairs, and an after repair value option. So the lump sum option allows you to simply plug in a lump sum value. So for example, if you just wanted to plug in $100,000 for the loan amount, you could simply plug in $100,000 directly into the cell. Otherwise, the other loan options are based upon the analysis values that you've previously entered into the previous steps in the analysis. So if you selected the purchase option, that would use the purchase price amount of the property that you entered into step 2 of the analysis. If you selected the repairs option, that would use the repairs amount that you entered into step 3. If you selected the purchase and repairs option, that would be a loan amount for both the purchase amount and the repairs amount combined. And finally, the ARV would be a loan amount based upon the after repair value amount that you entered in step 1. One of the most common ways that hard money lenders lend for flip projects is to lend at 70 to 80% of the purchase amount and then provide 100% of the rehab costs. So for that scenario, we'll select the purchase and repairs loan option, which will use our purchase and our repairs amount for the loan balance. So now we need to set up the loan to value ratio that the lenders will lend upon. So again, it's common for hard money lenders to lend at 70 to 80% of the purchase amount. So let's just plug in 75% here. So if the lender's only providing us 75% of the purchase amount, that means they'll only be giving us $112,500 at purchase closing, which basically means we'll need to bring a down payment of the other 25%, or $37,500 to the purchase closing table. Now, the second part of the loan is the rehab funds, which the lender is providing 100% of the funds. So we can just leave that at 100% of the LTV here, and you can see the lender will be funding the entire $70,000 rehab amount. So you can see with the lender only lending 75% of the purchase amount, we'll receive $112,500 to purchase a property. Then they'll be funding the entire rehab amount of $70,000, so our total loan amount will be $182,500. So now that we have the loan amount set up, we need to set up the terms of the loan on the interest rate, the points, and the number of payments that we're going to be making to the lender. The annual interest rate is the rate you're going to be paying the lender on the loan amount. So generally, a hard money lender will charge somewhere between 8 all the way up to 15% interest for a hard money loan. So let's just plug in 12% here, and as we plug in the interest rate, you can see our monthly payment is being calculated in the financing results table on the right. So the next item is the number of monthly payments. So this is the number of payments that you plan on making on the loan and to your lender. So if you plan on buying, rehabbing the property, and then reselling the property in 5 months, you'll just enter 5 here. Now, some lenders, they may require you to make a minimum number of payments. So even if you did finish the property in 5 months, they may make you pay a minimum of maybe 6 or 12 months worth of payments. The next item to set up are the loan points, which are basically just fees that you'll pay to the lender up front at closing. Now, generally, a lender might charge somewhere between 2 to 3% of the loan value up front for points. And then the final item on the list is other costs. So some lenders may charge other miscellaneous underwriting fees, closing costs, and rehab draw inspections that may account to another 1% of the loan amount. So once you get the loan amount and the loan term set up, you can see your monthly payment calculations, your total interest payments, points, and other costs are calculated in the financing results table on the right. The monthly payment calculation is simply the loan amount multiplied by your annual interest rate divided by the 12 months in the year. Then to calculate the total interest payments, the calculation is simply the monthly payment multiplied the total number of monthly payments that you plan on making on the loan. In total, you can see our total financing cost for the monthly interest payments of $9,125 plus our points of $3,650 plus our other costs of $1,825 equals a total financing cost for the project of $14,600. Okay, so now that we've set up our loans, let's go over to the results page and let's review our project costs, our funding, and how much cash we'll need for this property. So on the results page, we have some tables that show you your project costs over time, so that way you can accurately forecast how much funding in cash you'll need throughout the project. So the project cost table at the top shows us when our project costs are going to be incurred over each month of the project. So you can see at closing, we'll need to pay $150,000 to purchase the property, plus we'll need to pay the miscellaneous buying costs and then the lender points and fees for a total of $157,025. Now, during the 3-month renovation period, we'll be spending approximately $23,000 per month plus $750 per month in holding costs, and then our $1,825 per month in monthly interest payments. So by the time we're done with this project, we're going to need about $239,900 in capital to fund this project. So the table at the bottom, it shows us how we plan to fund the deal with our lender's funds and our own cash. So again, at purchase closing, we're going to need $157,000, which again is our purchase price of $150,000 plus our buying cost of $1,500 and then the points and fees of $5,400. So remember, based upon our loan amount, our lender was only going to be giving us 75% of the purchase amount, totaling $112,500. So at closing, when we purchase the property, we're going to need to pay that remaining balance of the $44,000 with our own cash out of pocket. Now, during the renovation period, our lender is going to be reimbursing us for 100% of the rehab costs as the work is completed. So you can see here we are receiving the rehab funds of $23,000 each month from the lender as that renovation work is completed. So net, during the renovation and remaining holding period, we will only have to pay the monthly holding costs and our interest payments with our cash out of pocket. Now overall, by the end of month 5, when the project is completed, it looks like we're going to have about $57,400 of cash invested into this deal. The investor cash outlay and cash position table at the bottom shows how much cash you'll be investing into the deal during each stage and each month of the project, as well as shows your net cumulative cash position throughout the project. So one last thing to show you, if we go back to the financing setup page, let's show you the advanced loan options. So these advanced loan options are used to map out when and how the monthly interest payments, your points, and rehab funds are scheduled on the project capital timeline on the Flip Analyzer results page. The default settings for our financing costs are to have the loan points paid up front and then the interest payments would be paid on a monthly basis, and then the rehab funds would be held back and paid as draws as the work is completed. So usually lenders will require you to pay your points up front when you purchase the property. So you can see here in our table, these points are in the purchase closing column. But some lenders allow borrowers to pay the points out of the proceeds of the sale when they sell the property. So if your lender allows you to delay the points payments to the end, you can change the setting to pay the points at the end of the loan, which would move the points and other costs to be paid at sale closing instead of at purchase closing. Lenders also usually make you pay your interest payments on a monthly basis, but some lenders allow you to pay all of your interest payments when you sell the property out of the proceeds of the sale. If you change the setting to end of the loan, the interest payments would be all paid at sale closing instead of on a monthly basis. And then finally, most lenders will hold back your rehab funds for the renovations, and then they'll distribute those funds as draws based upon the work that's been completed. However, some lenders will provide a loan advance, and they'll give you 100% of the rehab funds up front at purchase closing. So if you change the setting to upfront, the lender will provide all $70,000 of the rehab costs at purchase closing. After changing these advanced settings, if we go back over to the results page, over to our project capital timeline, you'll see that the monthly interest payments and the points are being paid at the end of the loan, and then we're going to be receiving 100% of our rehab funds up front at purchase closing. So that pretty much sums up everything that you need to know about our financing setup and how you can set up your loans for your house flipping projects. If you have any questions, feel free to shoot us a message in chat or send us a support request.